Hey there. All right, all right, all right. Welcome to another episode of your weekly market update with me, your host, Sean Richard. So this is SRT Live. Thanks so much for joining me. And man, it has been a volatile couple of weeks over the past 2 weeks. So we've got a lot to get into today. We're going to talk some of the normal update information like the jobless claims, unemployment claims. We're going to talk about inflation. We're going to talk about a little bit about Ukraine. We're going to talk about the impact. We're going to talk about oil prices. We've got a lot going on today. I'm going to go ahead and pull up the Facebook group. That way, if you have questions, you have comments, you want to put them in the chat below, then I'm happy to address and answer anything that you've got on the video today. All right, so let's dive in. So today and yesterday, a little bit of a quiet day. We didn't have a whole lot going on. And so the focus then has primarily been on two things. It's been on the Ukraine-Russia saga, and it's been on inflation. And that's been a huge challenge for the markets in digesting it because it's causing a lot of turmoil, a lot of twists and turns throughout the days and the weeks, and ultimately have an impact globally and especially here on us in the United States. So looking at some of the critical kind of information that's going on with what's going on in Ukraine. So we've seen the United States, among other countries, we've seen corporations come out and place sanctions and other bans or boycotts on Russia, on Russian goods and services, and it's having a ripple effect. So we're seeing that trickle over into things like oil prices with everything that's going on in Ukraine. Russia is a major producer of oil. So, a lot of parts of the world are having to go to other sources to get that oil, and it's creating a little bit of a shortage in the rest of the world because of that. And we're seeing that trickle down into our gas prices. How many of you gone to the pump lately? Me. And you're filling up at $4 plus a gallon. If you're out on the West Coast, you're probably at $6 to $7 a gallon. So all my Texas friends, be thankful that we are only at $4 a gallon. So it might be a good time to go out and buy you that new Tesla you've been looking at. Elon Musk would love that. And so we're seeing those sanctions have a ripple effect as well. We saw Apple come out, shut down all its products and services to Russia. We've seen MasterCard and Visa shut down operations with certain banks in Russia, and all of that's having an impact. The eminent question remains is how is this going to impact, when we're talking purely finances, obviously we've got a huge humanitarian issue going on over in the Ukraine, and definitely our hearts and thoughts go out to the people of Ukraine. And the innocent civilians that are over there trying to simply survive. And we're very blessed to be here in the United States, and we're not having to deal with those types of environments. And so looking at the impact for us from a financial standpoint, the question really becomes like, what is the long-term impact? What is, for these corporations, obviously they're doing the right thing, but what is the long-term impact on earnings? Some companies won't have any impact whatsoever because they have very little dealings with Russia. Other companies may have a lot larger impact because they have regular dealings with Russia, and that's a big part of their economics. So watching that as we head further into 2022 will be it'd be interesting to see that unfold. Oil prices continue to surge. Let me share this with you real quick. So I'm going to go pull up. Boom. Here we go. Let's go a little bit bigger. All right. WTI, West Texas Intermediate oil, 125. It's actually down from where it was earlier today. It was up over $128 a barrel. So $125 a barrel and change right now. And we are at exceptionally high levels where, it's been north of 7 years since we've seen any kind of oil in this range. And we're going to continue to see this drive gas prices up. So we're gonna feel it at the pump. I'm gonna talk a little bit more about that here in a bit. But if we continue to see oil rise, which I've seen some analysts indicate that they're expecting to see 140, $150 a barrel, then we're going to see even bigger strain on the economics of our country as a whole. And again, I'll get into that in a bit. And so we want to keep an eye on oil prices. Essentially, higher gas prices lead to less consumer spending, right? If you've got to go out and it's going to cost you an extra 40 bucks, 50 bucks every time you fill up your tank, then you're probably cutting your spending in other areas. And that's going to slow down consumer spending, which ultimately slows down the economy, GDP, and could, don't have a crystal ball, but could lead to a recession. And there's a number of things a number of indicators that are pointing in that direction. But this is just one more indicator that could lead us into a recession here over the next, let's call it 18 to 24 months or so. And I'll touch on the other one as well here in a bit. So the more that oil goes up, the higher the price that we see at the pump. I feel like we could see $4.50 a gallon gas here over the next, month to 2 months. And so that's going to put a real strain on pocketbooks and wallets. Let's jump into kind of some of the numbers that we saw last week. So last week on Thursday, as we do every Thursday, we got the jobless claims or the unemployment claims. And so this is two-part. This is one, the people that are filing, number of people that are filing for unemployment for the first time, and that's initial jobless claims. The prior week on Thursday, we'd received a report of 233,000 new claims. The market was expecting 225,000 new claims. We only got 215,000 new claims, so a little bit lower. Kind of harkens back to several months ago when we saw some initial jobless claims at and around that 200,000, even slightly below. So the initial claims, new unemployment claims, coming in a little bit on the low side, which is good. We've got a healthy employment market, so not horribly unexpected. Continuing claims actually came in spot on, hit the mark. Previously it was 1.474 million. The market was expecting 1.476. We got 1.475. So we split the difference. So right in line with market expectations and not much of a market mover there, but lower than we've seen over the past several months. We also on Friday got the BLS, Board of Labor and Statistics jobs report. This is non-farm payrolls. And actually, let me preface this by saying on Wednesday, we got the ADP payroll change report. And the ADP payroll change report showed a stronger tick up in jobs. So that hinted at what we might see last Friday. And sure enough, that's what we got. The month prior, so this is for the month of January. The month prior, we got a reading of 481,000 job creations. The market was expecting 400,000 job creations, and we got a whopping 678,000 job creations. So a huge win on that. Shows how strong our labor market is. We've got healthy employment. We've got plenty of, a lot of job openings. So we've got a lot of room to have people go out and find jobs. The unemployment rate, because of this, ticked down from 4% to 3.8%. Mark was expecting 3.9, so we got a beat there, which was nice. So we're running at some pretty significantly low unemployment levels. Very healthy labor market is what we're seeing out there, which is great. We've been in the process of trying to come out of this pandemic. And unemployment was obviously a huge concern early on in the pandemic. You had companies laying off a lot of workers. You had furloughs happening, which potentially led to layoffs as well. And so I think unemployment spiked up over 10%. We are now way back to really pre-pandemic levels, very healthy job market. So let's talk about the week that's ahead. So yesterday and today, relatively light news week. On Thursday, we get the jobless claims, we get unemployment claims, as we always do on Thursdays. More importantly, in my opinion, we also get CPI. Now, if you haven't heard me talk about this before, this is Consumer Price Index. We actually also get PPI, Producer Price Index. And so CPI, or Consumer Price Index, is an inflationary report at the consumer level. So inflation at the consumer level measures a basket of goods. And so I'll explain this again for those of you who are watching me for the first time. This is essentially the same as you going out to the grocery store every single month and buying the same 25 items and totaling it up and looking at the cost. And so every month, if you do this, month after month over time, you're going to be able to gauge whether the price of those goods are going up or coming down. And so that's what the CPI report does. It measures a basket of goods. And the CPI report actually takes into consideration housing costs as well. There's another inflationary report called the PCE, consumption expenditure, personal consumption expenditure. Sorry about that. And the personal consumption expenditure actually excludes housing. And the PCE report is the Fed's favorite measure. But with housing being such a large portion of everyone's budget, and housing having such an increase in cost, both on the rent side and the mortgage side because of higher home prices, it really is a better view, in my opinion, to look at the CPI report versus the PCE report for more accurate inflationary information. And then we're also getting a 30-year bond auction. So mortgage bonds, bonds are finite, fixed products. And so they expire. In the case of a mortgage bond, 30-year mortgage bond, they expire every 30 years, or they renew or roll over every 30 years. So we're getting a bond auction on Thursday, which is the 10th of the month. Every 10th of the month, we get a 30-year bond auction. And so it'll be interesting to see what happens with the appetite for investors going after those bonds. And I wasn't planning on talking about this, but we've got the US and Europe looking at issuing bonds or treasuries to raise capital for defense and resource spending. And so if that happens, we're going to have a significant amount of bonds flood the market. And so it'll be interesting to see what the appetite is on Thursday for the bond auction. If it's a really low appetite, it could have an adverse effect on mortgage bonds. Now, this isn't necessarily going to impact pricing, but it does impact where bond yields are. So let's watch out for that on Thursday as well. Now, a few other things that I want to touch on. We're looking pretty good on time, so please don't hesitate to comment, ask questions if you have any in the chat. I've got us up over here and happy to answer anything. So what should we be looking at? What should you be looking at, as we head forward with everything that's going on domestically in the economy, internationally with the Ukraine conflict? What are some things that we need to pay attention to give us an idea of where we're headed? So first, I'll say, additional sanctions, boycotts, and bans of Russia. We're hearing more reports that we're going to see additional sanctions be placed on Russia. And although, obviously the aim of that is to deter Russia from the actions that they're taking, there is without a doubt a ripple effect in those sanctions that comes back to us here in the US. We're looking at creating less reliance on Russia, as is a lot of other countries and corporations. And that means we've got to find other resources, whether it be, another country, and it could have an impact on the cost of some of those resources as well. The US may decide to really start drilling domestically for oil and generating our own oil pipelines. So that way we can be less reliant on foreign entities for oil. So a lot of decisions that could be made in the coming weeks, depending on what continues to happen in the Ukraine-Russia conflict. I talked about CPI coming out this Thursday. That's number two. Where CPI comes out, where that inflation report comes out, is likely to influence the Fed at their meeting next week. The Fed is meeting next week. And so this is highly likely to influence their decision on what they do next week. If inflation shows that it's running hot as it has been, then the Fed may decide to take extra measures to try and curb inflation. And inflation has been a very, very hot topic. The market, the stock market, investors have been eyeing inflation for quite some time now. If you recall, the last CPI report that we got showed inflation running at 40-year highs, in absolute bananas. So if we see inflation staying that hot, the Fed's going to have to take some pretty dramatic actions to help curb that. So going into that Fed meeting, we've all heard about the Fed talking about rate hikes, and that's again the Fed funds rate, which is the short-term overnight lending rate, like for banks when they lend to each other. And so the Fed is talking about anywhere from 1/4 to 0.5% increase in the Fed funds rate. The conflict in Ukraine really puts pressure on the Fed to not hike as much as maybe they otherwise would have. So it's possible that the Fed was eyeing a 0.5% rate hike or 50 basis points. And with the conflict in Ukraine, we may only see 1/4% hike in the Fed funds rate. The challenge with that, and what the market doesn't necessarily like, is that higher rate hike would have gone further to combating inflation. And with inflation being one of the #1 culprits of the monetary or economic challenges that we're facing right now in our country, if they only hike the rate by 1/4%, the market may look at that and say that's not enough. That's not going to have a big enough impact on inflation. And we may see inflation continue to run hot or even rise, which would cause further challenges in the market. Now, relating that to mortgage, you've heard me say before, inflation is the enemy of interest rates. As inflation rises, interest rates rise as well. So if the Fed doesn't do enough to curb inflation and inflation continues to rise, then we're going to see interest rates continue to rise in the short term. So it'll be interesting to see what they do. We've heard talks of numerous rate hikes, 5 to 7 rate hikes over the course of the year. I think one analyst even said 10 rate hikes this year. It's going to be hard for the Fed to follow through on that. But I think what needs to happen is we need to focus, or the Fed needs to focus on a strategy and say, here's what we're going to do at each of our Fed meetings going forward. We're going to stick to this plan because when the Fed has multiple levers that they can pull, the question is which lever achieved the result. So anytime that you're doing trial and error, right? If you've got multiple levers, okay? If you pull both levers at the same time, how do you know which lever had an impact? Versus if you pull one lever, wait to see if there's an impact. Okay, no impact, put it back. Okay, then we pull the other lever, wait to see if there's an impact. All right, no, pull it back. Okay, maybe now we try both levers. And so the trial and error cycle is going to be harder if the Fed pulls multiple levers at a time, because the Fed, on top of talking about increasing the Fed funds rate, has also talked about reducing its balance sheet. And you've heard me talk about this before. I'm not going to bore you with it today, but go back and watch some of my previous market updates, and you can hear me talk about the Fed reducing its balance sheet with assets or bonds and treasuries. So will they focus on one lever at a time, or they're gonna pull multiple levers to try and have a faster, bigger impact? And so that'll be interesting to watch as well. I also want to show you this. Let me pull this up. So, mortgage-backed securities, mortgage bonds, are reversing from the gains that we saw. So pull this up here. Yeah, a little bit small. Yeah, so that'll actually work. Actually, we'll make it bigger for you. All right, here we go. So as you've seen me show off before, this is a chart of mortgage-backed securities. We are currently down 39 basis points on the 3% 30-year coupon. Not much you need to know here other than the mortgage-backed security pricing has an inverse relationship with interest rates. When mortgage-backed security prices come down, interest rates go up. And so as we've seen from here's the beginning of the year, right at the end of the year, and we've seen the price of mortgage-backed securities, the trend has been down, and we can even see right here that we had some gains, right? We had some gains when Russia attacked Ukraine. We saw a flight to safety. We saw a bunch of money move into from equities to bonds, and mortgage bonds benefited from that. So we saw a move up in mortgage-backed security pricing. We've since seen that reverse, and so we've lost everything that we essentially gained over the course of that period of time. And if inflation continues, and part of this is because of inflationary fears, or I would even argue the majority of it is because of inflationary fears, with the market thinking that a 0.25% increase from the Fed is not going to be sufficient to have a significant impact in inflation. And so we've reversed course. We've lost everything that we've gained over the past couple of weeks. And so it'll be very interesting to see what the Fed decides to do next week. And if we get that 0.25% increase, or if they do decide to go out on a limb and give us a 0.5% increase. And so we need to keep an eye on that. All right. Let me come back over here. So lots going on, a lot of information, a lot of data. I hope that all of you are taking care of your gas consumption. Maybe go fill up a couple of bottles of gas, so that way you can fill up before it gets too expensive. And again, go to your local Tesla store and start picking up those Model 3s and Model S's. Otherwise, you might find those gas prices going up a little bit too high. But if you want to talk more about what's going on in the economy, what's going on in the finances, how it relates to mortgage rates, how it relates to the real estate industry, definitely reach out to me, give me a call, and I'd be happy to go over that with you. If you or someone you know is looking to buy or refinance, please make sure to reach out to me. Happy to talk through that as well. Have an incredible rest of your week, and I will be back next Tuesday with another weekly update.